All right, let's begin. TradeRobotX, Cross-Asset Intelligence, March 19th, 2026. Today's focus is on what we're calling the fragile regime expansion. Okay, here's how we'll walk through it. We'll start with the macro regime, which hasn't changed. Then we'll get into the positioning that's driving prices, lay out the core causal chain, and look at the control variables, yields, and the dollar. After that, we'll cover the conditional asset response and ramp up with the execution reality. All right, first things first. It's absolutely crucial to understand that despite the recent moves we've seen, the underlying macro regime has not changed. That's our foundation for this entire analysis. Right. And this regime is defined by three key characteristics. Number one, it's supply sensitive. That means energy is a primary upstream inflation variable. Number two, it's yield dominated. Yields are the control variable for risk assets, period. And finally, it's liquidity fragile. Conditions are thin, so the market is very reactive to shocks. What we saw post-Fed wasn't a structural shift. It was just a catalyst for repricing within this existing fragile structure. Exactly, and that context is key to understanding the current price action. What we're seeing is a positioning-driven expansion. It's tactical, not structural. So let's break down the current market state. It's really just post-event repositioning. You've got equities moving higher on relief, the dollar is softening a bit, and yields are trying to find a floor after that initial decline. But the most important piece here is that participation is still very selective. This isn't a broad risk-on move. It's a tactical adjustment, largely from participants who were caught offsides. Okay, so to really diagnose these moves correctly, you have to follow the causal chain. It's the only way to avoid misinterpreting these asset moves in isolation. And here's the sequence. It starts with energy. That influences inflation composition. Inflation then drives yields. Yields are the key input for the US dollar. The dollar then dictates financial conditions, and only then do risk assets respond. The critical takeaway here is that this is all conditional and nonlinear. You can't just assume a move in one variable creates a simple, predictable outcome down the line. All right, so let's zoom in on the primary inputs of that chain, the control variables. We have to start at the top, with energy. When we look at oil, the source of the move is everything. Is it a demand-driven strength? If so, that's inflationary and supports higher yields. Or is it a supply-driven shock? That's completely different. It introduces growth risk and can actually pull yields down. Which one it is determines the path for everything else in the chain. Right, so that leads us from energy and inflation directly to yields, which is the central control variable. We saw the post-event drop, and now we're seeing stabilization. The key now isn't the absolute level of yields, it's the velocity and persistence of the next move that's going to matter. Exactly. So as the stabilization takes hold, we're watching two things very closely. First, real yields. That's the primary input for risk pricing. And second, the shape of the curve. If we see flattening, that's signaling inflation persistence. If we see steepening, that's signaling rising growth concerns. The character of these yield moves is what's going to determine whether this risk expansion has any legs. And that brings us to the US dollar. The softness we're seeing right now, it's just a positioning adjustment. Yes, it's easing financial conditions at the margin, but this is not a sign of structural weakness. A sharp reversal in the dollar remains a very real risk here. Okay, so that covers the inputs. Let's talk about the output layer, the actual asset response. And we have to remember, asset performance is a result. It's a consequence of those control variables. It's not an independent signal in itself. Looking at equities, this move needs to be seen exactly for what it is, a conditional, relief-driven move. It's entirely dependent on yields remaining stable. We're not seeing broad participation here, and the underlying structure is still fragile. And if we look at other assets, the same logic applies. Gold is getting a bid from lower nominal yields, but it's capped by where real yields are. Bitcoin is simply responding to a marginal improvement in liquidity. Each is just reacting to a specific input from that causal chain. And that point on liquidity is critical. Yes, it's improved marginally since the event, but let's be clear. Overall liquidity is still thin. And in this thin environment, the implications are straightforward. You get faster, more abrupt price moves in both directions. The market's capacity to absorb any kind of shock is lower. And that means the risk of a sharp reversal is elevated. This kind of liquidity amplifies whatever is happening, whether it's continuation or failure. So all of this brings us to the execution reality. How do we operate in this environment? What's the framework for observation? Okay, here's what matters right now. These are the variables to monitor.
1. Does yield stabilization hold, or do we see a renewed move? 2. Does the dollar softness continue, or do we get a sharp reversal? 3. We need confirmation on the oil composition. Is it demand or supply? And 4. What is the quality of the equity market follow-through? These are the factors that will determine what happens next.
So the core principle for execution is simple. This is a reaction-driven environment. Confirmation matters far more than anticipation. Right. So to wrap this all up, don't mistake this price expansion for a regime change. It's not. Yields are still the control variable. Liquidity is still fragile. This move is all about positioning. The surface calm we're seeing right now doesn't mean there's structural stability underneath. The regime's fragility is just being masked. It hasn't been resolved.